guys, welcome back to another episode of Singaporean Talks Money. So I'm coming up with a new series called Portfolio Dissections, where I talk more about the individual stocks that I hold, why I bought them, and also whether will I be holding them in the long term or I'll be selling them soon. So information are accurate as of my release time, and I hope that you enjoy this new series. Please do give a thumbs up or subscribe to my channel if you like my content so far. So let's have some introduction first. So I'm going to be talking about Nikko AM STI ETF and SPDR STI ETF today. So both of them target to replicate as closely as possible before expenses the performance of the Straits Times Index. So the different names of it, like Nikko AM and SPDR, is because they are managed by different asset managers. So some other differences between them would be that firstly the fund size, secondly the expense ratio, tracking error, and dividends. So there are many articles out there listing the differences, so I wouldn't go too much into it. So US has the S&P 500. Similarly, Singapore, we have our very own STI ETF. So currently the top 10 holdings of STI ETF are shown, and with the top 3 being the banks, DBS, UOB, and OCBC, whereby 3 of them personally already accounts for more than 30%. And we can see some other familiar names among the top 10. So the top 10 holdings also account for about 67% of the total assets. So first, let's talk about Nikko AM STI ETF and why it is in my portfolio. So actually, it is the first thing that I started buying in 2017 through the POSB Invest Saver. So currently, it is not held in my CDP account, but under DBS, and I can access the holdings through my iBanking. So at that time in 2017, I wanted to start investing, but I didn't want to go through the whole process of creating a brokerage account and a CDP account. And after researching, I found out about POSB Invest Saver and also about dollar cost averaging. So I came across POSB Invest Saver and found that dollar cost averaging can be easily implemented through my internet banking. So I was still a university student at that time, but I earned some pocket money through tutoring and decided to start a regular savings plan. So at that time, I was consistently buying around $100 monthly, and I slowly increased it to about $300 monthly. So I started it, and then I did have some breaks in between the years. Hence, I had some varying prices where I bought some units at $2.95 all the way where I bought even at $3.43. So currently in terms of profit and loss, I'm down about $295, but dividends wise, I have received similarly about $295 as well over the years. So after that, I googled and realized that there is also a SPDR STI ETF, which has been around a longer time than Nikko AM with a larger fund size. I decided to then buy SPDR in a lump sum and also a few months in the regular savings plan with FSM1 in 2020. So I would think that both track the STI ETF, and there are many comparison articles out there. For me, I would be holding them for the long term because dividends wise, they are paying pretty good, definitely depending on the prices you bought them. On average, it has generated about 3% for me, which is definitely a lot better than bank interest rates. So, next thing that is always on everyone's mind. Should I still invest in Singapore, and particularly the STI ETF? So there have been many articles recently talking about the poor performance of STI ETF, and that many have shifted over to the US or Hong Kong markets. For me, I like having a Singapore portfolio as a base first, and also for dividends. If you do not like the STI ETF, you can look for REITs, banks that can really pay good dividends, and the dividends are not taxable. So by having a Singapore portfolio, you can slowly build upon it and then move towards the overseas markets as you have more capital. So in 2019, I moved towards buying US ETFs as I find the price volatility higher, meaning that the increase and drop daily are by the dollars. Whereas in the Singapore market, the volatility is lower and usually by cents. So in terms of that, and with me being 25 years old currently, I find myself wanting to take on more risk as the rewards could also be more. So another thing is that I wanted to avoid home country buyers as well. And that's why I moved towards a US market. So you might feel that investing in the Singapore market is a good idea because you are very much more familiar with the companies, or maybe you have seen it before. But thinking that and favoring companies from our own country over those from other country or regions could be a mistake. Considering our smaller population, and solely investing completely in Singapore would be a little dangerous, although there are definitely tax benefits to investing in Singapore as well. So after building a Singapore base, I decided to slowly venture out. With that being said, I know that Singapore stocks aren't interesting, but there are people who have benefited a lot just by concentrating their Singapore portfolio to the good few stocks. And I know that too much risk can be detrimental to my portfolio, as the value could be fluctuating in large amounts, making me maybe unable to sleep in the night. Hence, I will still be putting my money into the Singapore stock market, particularly into REITs. So for STI ETF currently, I will not be putting in any more money but will continue to hold on to my existing units. So I hope that you guys enjoy today's video. Do stay tuned for the other episodes on this series as I go through more on my portfolio. Appreciate a thumbs up and subscribe to my channel. See you guys next week.